All right. Today is Monday, March 28th, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight, and let's dive right into it because we have a lot to catch up on. And here it is, in focus tonight. The bear market is over. Yep, somebody said that, and retail buys the dip once again. And lastly, viewers' questions and answers. Actually, it's one question, but it is a good one. Somebody called the bear market over. It's done. We're out of the woods. All-time highs, baby, coming right near you. And that somebody is, you guessed it, Jim Cramer from CNBC. Because Jimbo said and declared, I think the bear market is over. It's done. All-time highs. Take a listen.
Maybe, Jim, you make the case, and you can make the case, that everything the professor said is known. It's all in the market.
That's it. That's
Jay
why.
Powell has messaged. He's told you.
That's why
he's told you what's coming.
Have you looked? There are 600 companies that came public in the last 18 months. I mean, there's like 7 on the trade north of $9. I mean, this is the bear market, just like 2001, except for we have rates much lower. And Brian, you remember those days? I mean, those companies were all jokes. A lot of the companies. I'm looking at all the companies that are under 10. Many of them are actually making money. We are in some weird market that it's a bear market. And no one called it as a bear. And I think the bear market is over.
Wow, and that's a big call. Brian Belsky, react to that.
Well, I think the bear market has been over for a while when you have over 70% of the stocks in the S&P 500 down more than 10%, and you have 50% down more than 50%, I'm sorry, 10%. But I think the key thing that is difference between 2001 is, remember, was we were by the dip craze big time, and we were still so focused on one area, that being technology. I think the market's actually done a really good job diversifying itself. But remember, too, the interest rate scenario goes up because the economy is improving. And that should be very, very good. Remember, stocks lead earnings, which lead the economy. And so it's already in the market. We already know this stuff. And this incessant need for everybody to know everything all the time, Scott. The Fed did a wonderful job last week kind of mapping this out. So we know the chart path. Now let's invest accordingly. And that's why the market's going up.
I love how they talk about something that is known, so we don't have to worry about it anymore. Meaning, if we know all the risks, the Fed, the war, inflation, once we know that, then we can just put our blindfolds on and rally higher again. Because these things, once you know them and you become aware of them, they just cancel themselves out. What a lot of shit. When we talk about the Fed as a risk, that is a legitimate risk to the bull rally. Because when you tighten the monetary policy, this is going to have a negative impact on the stock market. And we haven't even seen the beginning of that impact yet. When we talk about the war and the increase in inflation, you can brush that off and say, oh yeah, we know about the war, or we know that inflation rising higher. Who cares? Let's just buy stocks. Well, the rise in inflation damages corporate earnings. So you can play this cute game at the moment and say that we don't have to worry about anything because everything is known, all the risks are known. But sooner or later, you're going to have to face the music. When corporate earnings come out light, when the projections and the outlooks come out light, what do you do then? When the monetary policy crushes valuations more and more and more, what are you going to do then? Because the majority of the rally in recent years has been multiple expansion. And this expansion has been only possible because of the Federal Reserve's policy, the easy money loose policy with pretty much zero interest rates. You change that and you now have multiple contraction. And when you say the bear market is over, this has to be the fastest bear market in history. And we know that that's bullshit. The shortest bear markets in history only ended that short because the Fed rescued the stock market. Bear markets don't end in a couple of weeks or a couple of months. They last for a long time. We must ask the question, did anything change when it comes to the Federal Reserve and the monetary policy? Did the Fed come out and say, hey folks, forget about the tightening of the monetary policy and raising interest rates? We were just bluffing. We're not going to do any of that. We're going to go back to dovish mode. We're going to start easing again and print, baby, print. Did I miss that one? I don't know. Did I? So how could you call the bear market over when the Fed didn't change the policy yet? And they cannot change the policy. They cannot change the trajectory of the hawkish policy because inflation continues to move impulsively higher, and the Fed remains behind the curve. But this is Jim Cramer after all. You take whatever he says with a grain of salt, and you pretty much want to do the opposite of what he says. And if you're not sure, let's go back and revisit Jim Cramer's greatest hits. We start with number 1, the greatest hit of them all, Bear Stearns. Take a listen.
Okay, Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine. Do not take your money out. This is real. Look, if there's one takeaway other than a plus 400 somewhere, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly. Don't be silly.
Okay, just so you get a sense of what's causing the agony by this point, I know you've been talking about it. It's financials led by Bear Stearns after what essentially is a bailout from the Fed. Bear Stearns shares are down 90% this morning, and it's not just Bear. Pretty much every single bank is plunging in early trade this morning. Lehman, which is very similar to Bear and its reliance on fixed income, is down nearly 30%. You have big names like Goldman Sachs down 8%, Citigroup down 8%. So it is pain across the board this morning, and as you know, it all emanates from the shock this weekend that J.P. Morgan, along with the Fed, was going to be bailing out Bear Stearns for $2 a share. This is a stock that recently was trading at 80. Last year was trading at 160. It is the fifth biggest bank on Wall Street. It is significant in that it is establishing a price for some of these hard-to-value securities, and as you are well aware, that price is pretty much zero.
So the guy says, don't pull your money out of Bear Stearns. 6 days later, the company goes bust. Good call, Jim. But here's another one, perhaps a more recent one. The transitory inflation. And this was back in March 17th of last year. Take a listen.
Pay no attention to the inflation behind the curtain. Yep, Fed Chief Jay Powell took a page from the Wizard of Oz playbook today. And unlike in the movie, he was dead right. I mean, that's really what triggered today's rally, with the Dow jumping 189 points, new record, S&P advancing 0.29%, and the Nasdaq gaining 0.40% after being down more than 1% for most of the day. Even though the economy's heating up, Powell insists he'll keep interest rates low through 2023 because it's a mistake to worry about inflation right now.
We've still got 6% unemployment. There are bigger fish to fry. Now, a lot of money managers take their cue from the bond market, and bond investors simply refuse to believe the Fed should be or would be so accommodating. These money managers, I'll tell you what they're doing. They're missing out on some very big stock moves. If instead you recognize that the Fed is the stock market's friend, well, you'll catch these moves.
Honestly, though, we've got all these new investors who pay no attention to the Fed or the bond market at all. You know what? They're making out like bandits. You may not like it, but in this market, ignorance, it is bliss.
House of pleasure.
So again, if you listen to Jim Cramer, who said, hey, you don't want to miss the opportunities because Jerome Powell is right, he got the inflation plan all right, there's no problems here, inflation is going to be transitory, and trust the Wizard of Oz, Jay Powell, and buy the risk on kind of charts. The poster boy for the risk on is RKK. And if you bought that chart back then and listened to Jim Cramer, you went down, about 58%. Nice. Another one. How about his call from October of last year to buy PayPal? Buy PayPal! Jim Cramer Investment Club! Buy PayPal!
Oh, I've never met a younger person that didn't say, you know, you want to talk more about PayPal. I mean, they love PayPal. It's like they love their bank. I mean, who loves their bank? I don't love my bank. I fight with my bank. PayPal is loved. My kids love PayPal. It's exhausting. So while the stock remains expensive, I think it's worth buying now that it's down 17% from its highs, which is why we added some for the charitable trust last week.
And if you listen to Jim Cramer and you bought PayPal right when he told you to buy it, you went down, about 65%. Not a big deal, right? It happens. Markets are unpredictable sometimes. But here's my favorite. When he, just listen to it.
The larger ones, they tend to be much, much better than the smaller ones. Doesn't make them a sure thing. But it means they're sometimes worth buying on a case-by-case basis, which brings me to the one I want you in on. Didi, D-I-D-I. That's the Chinese version of Uber that's coming public on Wednesday. This company has a stranglehold on China through ride-sharing market they own. They crushed their competitors and then bought them up when they got tired of losing money. That includes Uber China. Didi's also got some really huge backers. Chinese tech giants like Alibaba and Tencent, a Japanese conglomerate like SoftBank, even Apple is in Didi. Finally, based on the proposed price range, which values Didi at around $65 billion, I think the valuation seems eminently reasonable. Now, there are some antitrust concerns here, but as long as they stay on the Communist Party's good side, and I know it's probably hard to do, but as long as they do, I doubt they'll have much trouble with the regulators. So if you want to speculate on a Chinese IPO, you've got my blessing to bet on Didi. I would try to get as many shares as you can.
If you took Jim Cramer's advice and you bought DI, all in, as much as you can, you went down, about 90%. Wow. So obviously the guy knows what he's talking about, right? So when he says the bear market is over, we take his word as the gospel. Anyways, now let's deal with the other antique that you heard from earlier in the video. Brian Belsky from BMO, another professional pumper. That's all he is, really. And listen to his logic, or lack thereof.
Good afternoon. Steve also made the argument that it's arrogant to be bullish. I think you have to have faith to be bullish. It's arrogant to be constantly bearish and constantly fear-filled and constantly rhetoric-filled and constantly macro-driven.
Yeah, stop being constantly macro-driven. What do you like, facts? Stick with faith to be bullish.
The stock market is a market of stocks. You can't name 2 or 3 stocks because earnings are going down there and apply it to the 500 stocks in the S&P 500. In fact, if you actually do the work and do the math over the first almost 90 days of 2022, earnings projections for the S&P 500 on a bottoms-up basis, the number is increasing. Nobody believes it because nobody's done the work, Scott. They're applying it to a couple of stocks that
You're the
I'm the only one
who's
that's
done the
publishing
work?
on it. I'm the only one that's published on it, Scott, because people don't want to be controversial and dig into the numbers. You've got analysts and strategists lowering their forecasts, and I just think it's too early. And we will adjust our forecast if we see something fundamentally changing
When?
for
After
the
it
second
already
half of the
turns
year.
lower?
And I love how the host is challenging him and his bullshit, because he says, I'm the only one doing the research. Really? What research? And then he says, if something changes in the macro outlook, the macro you're supposed to not be obsessed with, if something changes in that, then we'll adjust our targets and upgrades and downgrades in stocks. In other words, the fools at BMO will wait till stocks crash and then they're going to downgrade. Because wait till you hear their insane S&P 500 price target. Hint, they're already off. Way off. Continuing.
No, Scott. No, you don't downgrade your forecast after the market goes down. You downgrade your forecast after a rally. That's number one. Number two is something that no one's talking about, is that Powell came out last week and said, hey, excluding the war, which I know is a reality, excluding the war, the Fed's forecast and the Fed belief was that inflation was going to peak sometime in the late first quarter. No one's talking about that.
How many face palms can I get here? He's buying the bullshit from Powell. Conniving, manipulative Powell. Criminal Powell, who cannot be man enough to stand right before us and say, you know what, folks, I was wrong. I was wrong about transitory. I got it wrong. But now I'm going to do what it needs to be done to fix my mess, to clean it up. But instead, Powell said, we're going to retire transitory. It served its purpose for a while, but now we got to move on. Please don't ask me about it again. And then Powell says, this is during his conference, by the way, he said, everything was on the trajectory of inflation peaking this quarter. So he went back to inflation being transitory again. Inflation was supposed to be transitory. But then came the war. It ruined our transitory story. Folks, are we children to believe this garbage? Powell is shifting the blame from him to the war. He's not taking responsibility. He thinks we're stupid. War or no war, inflation was not going to be transitory. Did the war in Russia-Ukraine, did Putin cause your rent to increase and it continues to increase every single day? Rents are skyrocketing across the country. Is that due to Putin and the war? Again, Jay Powell and Biden and the rest of the criminals are gaslighting us that, inflation was supposed to be transitory, but then came the war. And this antique here, Brian Belsky from BMO, is buying that bullshit narrative. And he's basing his thesis that the bear market is over because Powell said something. Powell, the liar who got it wrong from the get-go, this is the guy you're believing right now? Wow.
On a month-over-month basis, the numbers are already starting to see that, even with this spike in oil. And by the way, oil is all over the place. It actually has more of a downward bend to it, Scott. So I just think that there's people making these macro arguments without actually doing the work. And that's why you have to be an investor in this, and that's why you will miss out on weeks like last week if you are fear-driven and rhetoric-driven and not doing the work.
And again, all of this is bullshit. You don't have to miss on anything if you have a pragmatic strategy, if you know what's going on in this market. And we talked about it over and over and over again. You have to have the investment strategy and the trading strategy. The investment strategy, stick with the winner. the inflation winners. This is what we do in late cycles. You buy the inflation winners, companies that are beating inflation. You buy the dips in those. But then technology and all of these high multiple names that get hit when the Fed is tightening, you fade the rips on those. But when they become oversold, like we've seen about 2 weeks ago, you buy some call options in those because these bounces are big and powerful and you don't want to miss them. And if you adapt such a strategy, you're not going to miss out on anything. The problem is, and these monsters don't care, by the way, all what they care about is the quarterly performance. And so far, it has been shitty quarterly performance. So they're going to miss out on bonuses and all the payouts they were supposed to get. So what do by the end of the quarter, meaning the end of this month? They pump the market with investors' money. The billions and billions of dollars that you trusted these morons to handle for you, they're going to pump it to pump the market higher and minimize the damage so they can squeeze in whatever bonuses and financial incentives. And that's all what they care about. They come out to CNBC, Fox, and the rest of them to pump their books. They talk their books. That's all they do. They don't have your interest in mind. BMO specifically has a history of pumping, with no regard to logic or facts at all. For example, back in the trade war, November 27th, 18, they said or told us to expect an upside surprise that the market is not prepared for. And guess what? If you bought that surprise, you went down about another 13% until Powell came to the rescue. There was no surprise at all when it came to the trade war. July 19th, 21, BMO says too many people are focused on inflation. Who cares about inflation? It's not a big deal. It's just transitory. And we now know that inflation is guiding everything in the stock market. It's guiding everything on the monetary front. So yeah, don't pay attention to inflation. Come on. Just buy stocks already. October 19th, 2021, they say tapering is fully priced in. It's a non-issue. Friday, November 19th, 2021, BMO says the secular bull market is alive and well, and they set bullish S&P 500 2022 target. December 1st, 2021, BMO's investment chief just predicted a 17% stock market gain for 2022. Ignore the bears, he says, and make room for these 3 outperform stocks. Hint, most of them are down. And by the way, since then, the stock market went down 17%, not up. But they doubled down. February 18th, 2022, the S&P 500 will surge by 20% this time around. Forget about 17, 20% by year end. And recession fears? That's overblown too. That's according to the same gentleman, Brian Belsky. We'll see about the 20%, Brian, but when it comes to recession, we already have an inversion right now, today. The first time since 2006 between the 5 and 30 year. The last time we saw that was 2006, and we all know what happened just a couple of years after the inversion. And perhaps the most important inversion is between the 2 and 10 years. And when it comes to that, it is tick-tock, baby. Tick-tock. Just a matter of time. And here's the bottom line, folks. I tweeted this on March 25th. To put things into perspective, back in January 4th, 2008, the Qs, but you can use the SPY or the Dow Jones, doesn't matter, broke its trend and entered into a bear market territory after dropping 25% from the highs. By March 17th, it's always March, right? The market bottomed, quote unquote, and rallied almost 23.5%. And we did not see the next leg down until September of 2008. And if you bought the so-called bottom in March 17th, by November, you were down 40%. And what rescued the market, by the way, and the economy from getting into a depression that time? The Fed. So lesson number 1, we could have these massive bear market rally, and they could stick for a while. But that doesn't change the fact that the trend is broken now. And it is a dangerous assumption to say that the chart is going to climb its way higher or to all-time highs like nothing happened, absent of a change in the monetary policy. And so far, we're not getting any change. They continue to double down on the hawkishness. Lesson number 2, what rescued the market back in 2009 was the intervention by the Fed. If the same crash happens again this time around, the Fed doesn't have the same amount of ammo. They now have limited options if we have a stock market crash or an economic crash. So this is a dangerous game to play, to be so callous, so reckless, and so obtuse to the surrounding facts. Yes, the macro-driven environment is important to understand. Your eyes are supposed to be in macro and the monetary policy, not on faith, because for all you know, what these fools are talking about right now could be the return to normal phase, which is a bull trap, by the way. I'm not saying this is it, But I'm saying, what if? And you're celebrating and jerking off prematurely. The bear market is over. What if this is what we're going through right now? This is the chart of the Qs, a weekly chart. We've broken the trend, we got into the denial phase, and now we're back to the return to normal phase, where everybody's assuming that we're back, nothing gonna stop us now, the stock market is gonna go back to all-time highs, and then earnings hit, and we realize that inflation is a big problem, the consumer is not spending anymore as he used to do before, and earnings are being contracted, and the outlooks are not so hot so. And now we have the Fed tightening the monetary policy because inflation is not stopping, and then the market goes once again. What do you do then? But I have a feeling that this call by Jim Cramer will be added in his greatest hits. Perhaps it will end up dethroning the Bear Stearns call. So congratulations, Jimbo. By the way, the Jim Cramer Investment Club, that is the easiest way to become homeless. Anyhow, let's move on to another subject that ties in with this insanity, which is retail. Retail lost their mind long time ago. They've always been labeled as dumb money for a reason, of course, and they continue to prove themselves over and over and over again as indeed dumb money. Guess who's been buying the dip aggressively as of late? The answer is the retail crowd, over and over and over and over again, and it has been catching a falling knife for a long time now, until a couple of weeks ago. Matter of fact, last week's inflow were the biggest in 6 weeks. We're talking about $14 billion. So what changed here to motivate the retail crowd to pour in $14 billion plus into the equities market? Is inflation over? Did the Fed change the policy all of a sudden? Or is it just stupidity again? Because as you can see, they bought equities, a lot of equities flows, and this is the biggest since February 9th. What did they buy, by the way? They bought equity growth funds, not a surprise, and hence you're seeing growth moving higher. The technology names, software, the riskiest assets, the meme stocks, all moving significantly higher because we're seeing billions and billions and billions of dollars being poured into buying these garbage stocks. It's fun to trade, don't get me wrong, but so long as you distinguish between trading and investing. When it comes to bonds, the retail crowd bought some general domestic taxable fixed income funds, as you can see in brown, and they also bought loan participation funds, as you can see in orange. But the retail crowd is engaging in risky behavior. Some of these risky behaviors are not new to us. It has been the theme in 2020 and 2021, but this theme has been absent so far in 2022, until now. Some of these risky behaviors involve trading options and buying levered indices, for example, the TQQQs. Take a listen.
The volatility in the market and tech in particular has led to a change in investing behavior. CNBC contributor Gunjan Banerjee of the Wall Street Journal reporting that market swings have triggered a stampede into tech-heavy exotic products as the riskiest, costliest way to invest is becoming the most popular. Gunjan joins us now to discuss that trend and its implications. Good morning to you. One of the most actively traded products is the TQQQ. It's designed to triple the daily rally of the NASDAQ 100. So how are retail investors using it, Gunjan?
That's right. There has been just an exodus into these types of products. They are some of the most risky products in the entire market, and they offer leverage or inverse exposure to specific sectors of the market, major indexes. And as you mentioned, one of the most actively traded products is this one that's designed to triple the daily return of the NASDAQ 100 index. And it's one of the most popular products, especially among individual investors who are saying, I want to go all in on tech. I'm not looking to take my chips off the table. I want triple the exposure to this tech-heavy index. And of course, this can lead to some explosive one-day gains and also some big losses for investors.
Now again, you can trade the TQQQs, the SQQQs, the UVXY. You can trade those and, matter of fact, own them for a short amount of time. They're not meant to be a long-term buy and hold because the risk is just too high. And there is a lot of fallacies and misunderstanding on how these leveraged indices work. For example, a lot of TikTokers say if you buy the TQQQs, if the regular Qs ends the year up 10%, the TQQQs will end the year at 30%, which is bullshit, by the way. It's garbage. It's not true. The TQQQs tracks the Qs on daily basis. If the Qs gains 1%, in a day, the TQQs appreciates 3% during that given day. But there is a flip side to that coin. If the Qs goes down 1%, the TQQs will go down 3% for that particular day. And when the Qs doesn't move at all, you could see the TQQs holding these losses for a longer time. So you could actually end up underperforming the regular Qs if you hold the TQQs in your portfolio as a substitute of the actual Qs. But this is the kind of stupidity we've been seeing by the retail crowd for a long time. Now they're going to stampede on GameStop again, on AMC again. And what do you know? They're going to get flushed out sooner or later because it's just going to give the Fed more room to be even more hawkish and tighten more, faster, quicker, unwind the balance sheet right away. And we can tie up this point with the bear market is over point. The bear market is not over until we have extreme fear, extreme capitulation, until after we washed out all of this stupidity. But the bear market is not over when we still have people stampeding to buy GameStop and AMC. And by the way, they're getting excited by a stock split in Tesla again. That tells us that the mania is not over. It is still here. It was damaged a little bit, but it needs to get hit a lot harder. And for that, Jerome Powell and the Fed will do the job. You see, back in 2020 and 2021, Jerome Powell canceled all the dips. Any dip that you thought could be the end of the bull rally, Jerome Powell came to the rescue. But when the monetary policy changes, Jerome Powell now in 2022 will cancel any rally. The higher stocks go, the harsher he's going to be. He's going to cancel all of these rallies. Lastly, let's move on to this question from the viewer, which I thought it was a good question, and I'm going to expand on it a little bit. He says, cracking show again, Mav. In your discussion on gas, you discussed debt to assets ratios, operating ratios, liquidity ratios, and performance ratios. When you're comparing between buying opportunities, how do you weight these components? Okay, I'm going to answer this question, but I'm going to expand on it a little bit. When we talked about gas stocks and I discussed the debt to assets ratios, the point I was making is to answer the criticism that says, oh, you cannot invest in oil and gas because the debt's too high. The balance sheets are not clean. And I was showing you these ratios for different names to illustrate for you that the balance sheet for these companies are actually clean. They're the best they've been in a long time. But when we talk about the investment ideology, I made a video about 4 months ago, which a lot of people still don't understand. But someday after the fact, when people look back, you gotta understand that that video was critically important because I dropped a lot of clues in there. And when I assess what's going on in the market and how my investment strategy should be, I look at 3 things: the market cycle, the macro cycle, and the monetary cycle. Where are we in the market cycle? And by the way, this question was asked back in 2020 when everybody was stampeding in the mania and buying tech stocks, buying software, and the garbage stocks with no profits, with no revenues, yada, yada, yada. I viewed that as a reminder of the 1999 mania phase. And if you lived through that, you knew how this movie was going to end. And the trade was short the leaders. I started shorting Peloton, DocuSign, Zoom, RKK, Moderna, pretty much at the top of these stocks. And people called me back then when I started shorting these names as, oh, you're gonna lose a lot of money, you don't want to short in this market, you're crazy, yada, yada, yada. And these trades happen to be some of my best trades ever in history. Look at the trade of Moderna, shorting Moderna exactly at the top. That was a great trade, but now that's gone. That trade is gone. The 1999 crash in the stock market already happened. You look at all of these mania stocks, Blink Charging, Palantir, yada, yada, yada. They all crashed 60, 70, 80, sometimes 90% from the top. And sometimes you hear people asking, should I short now? Wait a minute, where were you when it was the time to short? When nobody wanted to short, when everybody was scared, that was the time to short. The market cycle was saying this is a 1999 mania-like phase, and shorting those leaders was the right move. And it was indeed rewarding. Now it's over, for the most part. What about the macro cycle? What do we see in the macro cycle right now? It is a 2007-like late cycle, in my opinion. What do we do in late cycles? We go long commodities, long inflation, specifically in energy, in gas, in fertilizers, in materials, and so far, so good. This trade has been outperforming year to date. And then the last thing I look for is the monetary cycle. And in my opinion, right now, we're heading into a 1929-like tightening cycle. What does that mean? What is the trade for that one? You short the indices and the big caps. The Apples, the Microsofts, the Teslas, the Nvidias, they tend to crash during that stage. Heading into the crash of 1929, interest rates were moving higher. There was a lot of exuberance. Interest rates moved higher. and ended the party, among many other reasons, of course, that we can go through in details in a separate video. But we are not there yet because the Fed just began tightening. That's going to come down the road. So for now, in this mother of all bubbles, we have witnessed at least two great trades, shorting the leaders of the bubble, just like we did back in 1999. In this case, the RKKs, the Modernas, the DocuSigns, and this has been rewarding so far big time. Another great trade is the '07-like late macro cycle with energy, oil and gas, fertilizers, materials, aluminum, copper, etc. This has been also rewarding so far. And then we're going to have the greatest trade of them all, of shorting the indices and the big caps. But we're not there yet, at least for that one. Now, when you want to dig into one trade in particular, let's say the one that we have right now, the macro cycle trade. You want to be long inflation, for example, and you decided to be long oil and gas, but specifically gas, just like we discussed in the latest video. How do you choose which company, which stock should you invest in? For example, you might have 4 gas stocks that you like, but you're not sure which one should you buy. Then comes the analysis of, you can use the technicals, the valuations, earnings, growth, liquidity ratios, efficiency ratios, operating ratios, income statements, many other categories that you can use. And you rank these stocks, which one has the best technicals, the best valuations, the best earnings, the best growth, and you settle with the stock that has the highest scores for the most categories. By doing so, you're picking the best. And it is always a rewarding strategy when you stick with the best, because in the long run, companies with the best fundamentals, their stocks tend to outperform consistently. And this is exactly what you're looking for. But there is another way to think about it when you pick a stock. Let's say that your end goal is to pick whatever stock that is going to gain the most, because you believe that we're going to have a last hurrah rally in gas, for example, just like we saw back in 2007. It's going to be a massive shoot up higher, and then everything crashes again. And you don't really care about the best fundamentals. You just want to pick the stock that is going to produce the most gains. Then there are other categories that you can look at. The market mechanics, options Greeks, and the beta for the stock, because the highest beta tend to move in the most volatile way, up or down. For example, when we look at the list of stocks that I shared with you on Friday, I did not include the top gainer in the gas category, which is the ticker TELL, because it doesn't pass my threshold of certain fundamentals. But it is the highest beta name. It is the stock that is producing the highest gains when gas stocks pop higher. But it also happens to be the stock that gets cut the most when gas stocks drop down, just like we saw today. So this is an important question for you to ask. Am I looking for the highest gains if I believe that gas stocks will be squeezed higher, let's say all the way till the summer? Then you might want to go with TELL. But for me, my discipline says stick with the best, and the best will not disappoint you at all. You're gonna get the gains, maybe not as high as the crazy ones, but still decent gains, and you might avoid certain mind traps in these high beta stocks. So again, yes, for me, I do all of that analysis, all the ratios, all the valuation metrics, and I decided at the end of the day that this is the best name in the category. It has the best fundamentals, and I stick with that name. And I was never disappointed guiding my investment using this strategy. And with that, folks, we gotta move on here and cover the market information for you. We start with the closing of the indices today, and here we go! The Dow Industrial Average closed in the green by 94.65 points, or a gain of 0.27%. The Nasdaq leading the gains with 185.60 points, or a gain of 1.31%. The S&P 500 also in the green by 32.46 points, or a gain of 0.71%. What about the sector's performances today? Leading the pack, number 1, capturing the gold medal, Consumer Cyclicals, aka Tesla. And at number 2 for the silver, Technology. Number 3 for the bronze, REITs. And the laggards of the day, the winners for the year, Energy, Materials. We also see in financials and industrials closing in the red. What about the advance to decline ratios? NYSE 44% advancing versus 52% declining. The Nasdaq 44% advancing versus 52% declining. So the Nasdaq led the gains, but underneath it all, the breadth was actually bad. This is usually, not always, but usually a sign that we're gonna see a pullback in the Qs. Moving on to commodities, red across the board with few exceptions, and the reason is we got bad news from Shanghai. We have more restrictions due to the cases of the thing, and this is of course impacting the demand outlook, at least for now. For oil, crude oil was down big. The WTI was down a little over 2%, but Brent was down massively, almost 9%. Now, a lot of you have been waiting to buy the dip in oil. Once we have a dip, I'm going to buy. Are you buying now? Because this is as good as it gets when it comes to dips. I'm not saying you should or you shouldn't. I'm just saying it's easier said than done, because when you see the Brent is down a little over 9%, now all of a sudden you're holding back and saying, you first. I'm not going to buy the dip right now in Brent. But then if we see oil rebounding higher again, in all likelihood it will, because you heard Xi Jinping himself saying that we need a different approach. We need to update our approach of the zero thing cases policy. But it was a down day regardless for energy. Even gasoline, heating oil were down. Natural gas was down, be it under 1%. When it came to softs, OJ was down over 2.5%. Likewise, coffee was down over 2.5%. Lumber down a little over 1%, while sugar was pretty much flat. On the other hand, we have gains for cocoa, a little over 1%, and then cotton, almost 0.75% gains today. Metals, red across the board. Copper was in the flat line, but gold was down, silver down, platinum down, palladium down. Not by a lot, but again, when you have a scare in China, growth scare that is, guess who's the biggest consumer of all of these commodities? The answer is China. Meats, flat across the board. Live, feeder cattle futures, lean hogs, similar story. Grains, on the other hand, took it really hard. We're watching wheat. Wheat was down a little over 4%, but so is soybeans, soybean meal, soybean oil, corn, rough rice, all down, while canola was pretty much on the flat line. On the other hand, oats managed to close the day with gains of a little over 2%. Now, before I move on, yes, the lockdowns in China are impacting the demand picture in oil. What about the supply picture? Today we heard from OPEC, and OPEC is not changing anything when it comes to the supply. The supply will remain tight. So now we have a dip in demand, but that dip can be recovered right away if we have a reversal in policy in Shanghai. Moving on to the big casino, the options market. What's going on here? The hottest stable by far, believe it or not, was AMC. Yep, apes. At around 1.4 million contracts traded today. About 69% of those were calls. And at number 2, Tesla, the souffle, with almost 975,000 contracts traded today. About 65% of those were calls. And at number 3, Apple, with around 900,000 contracts traded today, about 61% of those were calls. And I like to watch the implied volatility because we have massive moves in names like AMC, GameStop, Tilray, Tesla, and when you look at the IV percentage, once you get above 90s, two things happen. Expect higher volatility, meaning bigger moves up or down, but also expect the premiums for options to become really, really expensive. So you get closer and closer to the end of the move, whatever that move was, to the upside or to the downside. So you look at AMC, it is at 91. It could squeeze a little more, but we're getting closer to the end of this leg higher. So you have to be an opportunist here and buy cheaper premiums because your goal is to flip these premiums for a profit quickly. And today I saw Snowflake with an IV percentage of around 78%, and the stock is moving higher. I saw a lot of call options buying, so I followed and I bought calls for Snowflake. And the goal here, if you look at the chart, there is a gap. If the chart moves all the way to close the gap, that would be a gain of around 13%. But regardless, if the implied volatility alone continues to move higher from the current 78% to let's say 85, 90%, and the stock doesn't move by a lot, let's say maybe another 5%, that would appreciate the premiums dramatically. And this is what I'm looking for in this trade. Let's move on to the unusual activities that took place in the options market today. We start with the ticker SPY for the S&P 500. They're buying puts again, the 385 puts for the expiration date, May 6, with the expectations that the SPY could drop down by more than 15.5% by then. They paid around 90 cents a piece to enter this trade, all in all spending around $2.7 million. And here it is, AMC. Somebody's fading the rip by buying puts, in this case the 23 puts for the expiration date, April 14th, with the expectations that AMC could drop down by more than 21.5% by then. They paid around $2.10 a piece to enter this trade, all in all spending around $5 million. And here it is, the ticker SNOW Snowflake, the buying calls lots of call options buying the Snowflake today. In this case, the 260 calls for the expiration date, April 1st, with the expectations that Snowflake could pop higher by more than 10% by then. They paid around $1.40 a piece to enter this trade, all in all spending around $2.5 million. And at the bottom of the table, what about the ticker IWM for the Russell 2000? They're also buying puts, the 182 puts for the expiration date, May 20th, with the expectations that the IWM could drop down by more than 12% by then. They paid around $1.80 a piece to enter this trade, all in all spending around $2 million. Continuing with interesting trades. What about the ticker UVXY? And I did follow this trade because the VIX got really crushed today. It is becoming really oversold. I'm just betting on a bounce by the end of the week. In this case, they bought the 14 bucks calls for the UVXY with the expiration date of this Friday, April 1st, with the expectations that the name could rebound higher by more than 5.5% by then. They paid around 45 cents a piece to enter this trade, all in all spending around $450,000. What about the ticker BBBY, Bed Bath & Beyond? Another meme stock. They continue to buy calls, the 30 bucks calls in this case, for the expiration date this upcoming Friday, April 1st, with the expectations that Bed Bath & Beyond could continue to move higher by more than 14% by then. They paid around $1.20 a piece to enter this trade, all in all spending around $1 million. And lastly, what about the trade for the ticker NTR, one of my favorite names, Nutrin? Somebody's buying puts here. Perhaps we will see a softening for the year-to-date winners trade, the fertilizers, oil and gas. We'll see. Too early to say, but somebody's betting in that direction. By buying the 95 puts for the expiration date, May 20th, with the expectations that the name could drop down by more than 11% by then. They paid around $2.50 a piece to enter this trade, all in all spending around $2 million. Moving on to the heat map analysis, what's going on here? The commodities-related winners, we're talking about energy, materials, steel, copper, agricultural names, all got hit today. Right off the gate, we got bad news from Shanghai, and that impacted all commodities-related stocks in the negative direction. Likewise, financials were down, even though the 10-year yield was not really popping higher today, but we have an inversion in the yield curve where the 5 years yield is paying more than the 30, and that impacted financials negatively. We're seeing the continuation of buying in technology, the meme stock, the high multiple names, but not by a lot. Matter of fact, the buying is concentrated within the big caps. We're talking about Apple, Microsoft, Amazon, Tesla, Google, Nvidia, and some options plays when it comes to software and the rest of technology. So this is not going to be sustainable once the options trades are done. Yet buying the big caps is an indicator that the retail crowd is here and they bought billions and billions of dollars worth of dips. Now, certain names I continue to watch are the defense contractors. They were down today in talks of perhaps a peace deal between Russia and Ukraine. They're going to play these games to pump the stock market, and then we don't have a deal and stocks go down. You know the story. But at the end of the day, are the fundamentals intact or not? For example, we're now hearing more defense spending by Germany, eyeing to buy a missile defense system. Where do you think that's going to come from? Lockheed, Raytheon, Northrop. So the tailwinds are still intact in defense. I'm also watching grocery stores, be it Kroger, which I own, or Albertson, because we have a massive strike here. 50,000 California grocery workers voted to authorize a strike. So this could push food prices even higher, folks. Not what the Fed needs to hear at this point. We also got the news that Mama Cathie Wood, Tesla witch Cathie Wood, is dumping Tesla. She sold Tesla. She took advantage of the pump and she dumped Tesla on Friday. She missed out on 8% gains today, but hey, she bought NIO instead. So now you got two names you're looking to short, Tesla and NIO. Anything that Cathie Wood touches turns into shit. Moving on to the heat map for the ETFs. Again, you look at the indices, the Nasdaq was surging higher, the Dow Jones closed in the green, the S&P 500 in the green, but all in all, it was a boring day. No major moves one way or the other. We look at the ETFs, obviously the losers are energy ETFs, XOP, XLE, OIH, all of the commodities related trades, including gold, GDX was down, anything when it comes to gas, uranium, URA, all down big. Nothing commodities managed to perform today. Thank you to Shanghai. And when we see these kind of days, when commodities are down and the year-to-date winners, the inflation winners are down, we see growth usually outperforming value. And this is exactly true today with the IWF, the VUG outperforming the VTV, and the IWD. The winner index today was the XLY for consumer cyclicals, but this is due to Tesla mostly. Tesla has a massive weighting here. When we look at international markets, China and Chinese equities go hand in hand with the Nasdaq. When we see a pop in the Nasdaq, the meme stocks, the retail crowd favorite names, we see Chinese stocks also moving higher. And that also comes hand in hand, by the way, with a drop in commodities and commodities-related stocks and trades. But then when the opposite happens, China goes down, and we actually see the EWZ, the commodities giant Brazil, starting to outperform. Moving on to charts, and we start with a 30-minute chart, the SPY, the S&P 500. Before we start, I'd like to go back as a reminder, because I hear from a lot of you, I've been hearing at least, a lot of you have been saying, hey Mav, I got rigged with the puts that I'm holding, the market keeps going higher and higher and higher, what's going on here? So let's go back to March 16th, right after the Powell conference, and see what I said about the SPY and this chart in particular. Take a listen. A gap higher in the morning. The chart started to look overbought on the RSI from a 30 minutes perspective, and I told you, any disappointment in the chart will flush down right away. And this is exactly what happened. The chart struggled to break above 434, and then it gave up, and it went all the way down, losing 430 as support, but closing the gap in the morning. And then what happened? Jerome Powell opened his hole, and we saw the rebound. And the chart managed to recapture 430 and 434 as support, closing at the highs of the day. Is the action, technically speaking, bullish or bearish? The answer is it is super bullish. Why? Because number one, the chart retested 430 multiple times. It failed once, but it managed to recapture the important line of 430 as support. And now it has a cushion in 434, even if we have a down day tomorrow. Number two, the chart went down to close the gap, and it managed to rebound higher, closing at the highs of the day. You cannot find anything that is bearish in this behavior. And hence, if we have a change of mind tomorrow and we see the bulls getting served pies in the face, it will be indeed a bull trap, because all indicators, at least technically speaking, were pointing out for more gains to come for the SPY. Okay, so I made it clear that the chart was super bullish, indicating more gains to come. So why didn't you close your puts at that point? Why continue to hold even though the chart is telling you repeatedly that it's going to go higher? And by the way, this rally so far has been really impressive in terms of charting behavior, because the chart has been, believe it or not, really disciplined in this rally higher. It cracks above a resistance level, and then it goes down and retested as support before moving higher. It opens a gap, and it goes down to close the gap, as you can see, right below 446.5, and then it moves higher again. It cracks above another level, and it goes down and retested before moving higher again. This is bullish behavior, not bearish one. So you have to listen to the chart. And I keep saying repeatedly when I do these charts analysis, the bears are not going to short until level so-and-so is broken. The bulls are not going to buy until level so-and-so is recaptured and retested. So again, I don't understand why certain traders continue to hold on in the same trade beyond the validity of these trades, when the charts are saying something completely different. Anyhow, when we look at this chart, it continues to grind higher. It managed to recapture 454 as support. It's now eyeing 459. Do we have any sign right now, right in front of us, suggesting that this chart is ready to reverse? Not really. Perhaps we're getting closer when we look at the daily charts in a minute. We're getting closer because things are getting overextended, but there is nothing right now looking at this 30-minute chart that suggests you should be shorting right now. You gotta wait for the reversal signal before you start shorting. And if you made some gains riding calls throughout this rally, you want to start thinking about booking certain profits, maybe 40%, 50%, 70%, and then let the rest ride. Here's a daily chart with the continuous contract of the SPY. And again, this is an impressive rally so far. The bulls didn't only manage to recapture 4,384.5 as support, but also 4,472, and today 4,549.5. These are impressive gains in a short amount of time. The problem is it's all done under low volume and at the end of the quarter. So these could be flows placed right now to pump the market higher, so these managers can close the quarter on a positive note, but after that things start to frizzle out. So we know we're running out of time here. This rally is running out of time. It is hitting the time wall, the time window for the reversal. The problem is, would this reversal be a big pullback, erasing 2, 3, 4, 5 candles worth of gains? That would be bad for the bulls. That would be a bull trap. Or would it be a stalling, a pause of the rally? Maybe, let's say, losing 4,549.5 or even 4,472 as support. If that happens, so far so good. Even going all the way down to 4,384.5, that would still be bullish. But then breaking below that number, and we have a different story. Watching the volume. The volume is going to bottom at some point, and it's going to start to rise higher again. That would be a clear indication of the reversal that we're waiting for right now. When we look at the momentum indicators, they made significant progress in a short amount of time, and they're now peaking. They're ready to curl down. Would it be a sudden drop, or would it be the pause and consolidate scenario, which is bullish? And here is the chart of the SPX, the daily chart. As you can see in white, this is the 200 days moving average. The SPY managed to close the week above the 200 days moving average. It continues to trade above the 200 days moving average so far. This is bullish, not bearish. The problem is the chart's going to run into 4,590, which is really stiff resistance. The question again, is it going to be a hard rejection, meaning a pullback, losing the 200 days moving average, or will it be a stall, a pause, a consolidation underneath 4,590 to build some energy before popping higher again? Two different scenarios. One of them is bearish and the other one is bullish. We're not going to know until we know, but the signs will be clear. We're going to cover all of that in this channel. What about the cues? 30 minutes chart, similar story with SPY. The charts are almost identical right now, which tells you that we're seeing massive flows in the same direction. We're seeing a rebound that started as a combination between short covering and a gamma squeeze, then retail inflow, then perhaps some institutional inflow to pump that rally higher and close the quarter on a positive note. Yet massive rebounds like this in a short amount of time, either they're going to flush down big right away, that would be bearish, but you have to watch for certain levels before you start shorting. We'll talk in a second, but another way the chart could work out all of these overextended impulsive reactions in certain indicators due to the massive rebound in a short amount of time is by stalling and pausing. And that is bullish, not bearish, because the chart asks for more buyers. It wants to move higher, but it's taking a break. The sellers are not showing up. The chart is stalling. It is asking for buyers. More buyers show up. The chart continues to move higher. But look at the behavior of the chart. At around 352, the chart retested that number over and over and over again, both as resistance and as support. What does that tell us, by the way? It tells us that 352 is an important number. And if we have a sell-off, you're not going to start shorting until 352 is breached as support, and the confirmation would be breaching 343 as support too. But by 352, the trade would be clear. For now, the support is at 363. The resistance that the Qs is eyeing right now is 365, but it could go as high as 369. And here is the daily chart for the continuous contract for the Nasdaq. It is pausing pretty much at the sweet spot, 15,000. I doubt that the chart's going to continue to move higher beyond 15,000. I think this is a good point to reflect. Are the bulls going to stall here and pause and keep 14,445 as support, and the chart just ping-pongs between these two numbers, 14,445 as support, 15,000 as resistance? That is the case, and that would be bullish. But if the chart pulls back and we see a sell-off and profit-taking rapidly, and 14,445 is breached as support, we go down to 14,000, 14,000 is lost, then we get a problem, a big one. It will be a solid shorting signal. We're not there yet. You look at the volume, look at the momentum indicators, we're waiting for when things are going to start to reverse. We're getting closer now. What about the IWM 30 minutes chart? Again, the chart speaks to us all the time by showing us important levels. In this case, 204.5 has been an important level due to many reactions over and over and over again as resistance and as support. So you know this level is important. Did the chart close below or above that level today? The answer is above. So you're not going to short this chart until you have a closing below 204.5. We also have, as you can see in this yellow trend line, at around 203, we saw another reaction, a double bottom for now. So that is yet another important level that you can use as a confirmation confirmation. Let's say the chart breaks below 204.5. You're waiting for confirmation. Your confirmation would be breaking 203 as support. And here it is, the Dixie dollar chart, a daily chart. The Dixie continues to move higher, and the reason is we have an important event in Japan, at least today. The Bank of Japan intervened to keep bond yields down, and it devalued the yen, and as a result, the dollar took a leg higher. My hunch is, psychologically speaking, they want to see 100 handle on the Dixie before things stall. So we're not going to fight it for now. The assumption should be the dollar will continue to move higher until we see 100 handle. What about gold? You got to remember this when you look at the chart of gold. Gold has two enemies. Number one, the US dollar. Number two, the 10-year yield. Both have been rallying impulsively year to date. So the fact that gold continues to hold on at these high levels year to date is quite impressive. What you should be thinking right now is, yes, gold doesn't look good from a formation, from a pattern formation, because it is flirting with a bearish pattern, a bear flag pattern at around the support, the Fibonacci support of 1,925. Who's to say that that support is not going to break at some point and we see a flush down? But you should also be thinking, what if the 10-year yield is also peaking for now, and it's about to take a leg down, and this would be bullish for gold to move higher. And here's the chart of Brent, crude oil Brent. We know that 118 is an important number. So when the chart fails to rally after breaking above 118, you know things don't look for crude right now, whether we have Shanghai or not. So we have to look for support. When we look for support, we find 105.84. We're getting closer here. Let's see how Brent reacts at around 105.84. If that holds and we have a rebound, then you have a green signal to buy crude oil. But you have to factor in the fundamentals too. Are the restrictions in Shanghai easing or not? Because more restrictions not going to be good for oil, at least in the short run. In the long run, all of these lockdowns are stagflationary in nature, and they're going to push commodities prices higher in the longer run. And here's a daily chart for the 10-year yield, an impressive rally, and it went hand in hand with the Nasdaq, which is quite peculiar, by the way. We're now facing the resistance at around 2.54. My hunch is we will see a pullback in the 10-year yield. Is it going to be all the way down to 2.34? That's not a big deal. Is it going to be below that? Let's say to 2.2, then we're talking. And if the Nasdaq and the 10-year yield rallied together, will they also drop together? When I say it is peculiar that the 10-year yield rallied higher along with the Nasdaq, because usually when that happens, it happens due to higher growth expectations in the economy. This is clearly not what's going on. The 10-year yield is moving higher due to higher inflation expectations and more interest rate hikes from the Fed. So somebody's lying here. Somebody's faking a rally. And my hunch is it is the Nasdaq. The Nasdaq caught an oversold rally that evolved from a short covering / a gamma squeeze rally to a retail stampede kind of rally. But that's going to fade because it was built on a phony foundation. You don't have the 10-year yield and the Nasdaq rallying together like this unless we have higher growth expectations in the economy. And that is not the case right now. And here it is, a weekly chart for the TLT bond prices. It went all the way down to 128, the last support. You break that support and we get a massive problem. My hunch is this support is going to hold. The chart is way oversold. We're looking for a relief rally in the TLT. We know that the longer term trajectory is for higher interest rates and lower bond prices. But can we have a relief rally in the meantime? I think we could. Here it is, the VIX 4 hours chart. The interesting phenomenon is the MACD indicator showed great impressions in the histogram, yet the VIX went down. This is the first time, folks, the first time we see this since June of last year. So this is an interesting phenomenon. Number two, the VIX lost the support of 20. Is this a sign of all clear for the stock market rally to continue, or is it a sign of complacency? Well, we're seeing a lot of reckless behavior right now in this rally. Buying GameStop, buying AMC, stampeding on call options again, getting excited of stock split by Tesla. This is eerily similar to the mania of the summer of 2020. So if anything I say, it is a sign of complacency. And I will take that chance now that the VIX is under 20 and now the premiums for puts are really cheap. I'm going to look at my portfolio. What are the highest runners that maybe will be subject of a pullback or maybe a big drop when earnings come, and I will start buying puts and hedge right now while everybody's excited about the pop and the meme stocks and the VIX breaching below 20. There is also another scenario of perhaps stretching the rubber band all the way, and then you see a massive shootout higher in the VIX. We haven't seen any sign that that would be the case for now, at least. We will know that if we have an impulsive rally, let's say starting tomorrow, we see the VIX recapturing 24.29 as support and perhaps closing the day above that number. Then we'll know that we could be seeing the rubber band scenario. A lot of folks will be caught with their pants down. Here it is, the VXN 4 hours chart. It has been holding and holding and holding at the support of 27.5 in a bear flag pattern. It appears for now at least that the bear flag is playing out. And if it is, are we going to go down all the way to 20 in the VXN 2? That would initiate a massive rally in the Qs. I doubt it. I think there is a trap coming here. Look at the MACD indicator, for example. It is bottoming. The negative momentum is bottoming, meaning the VXN could pop higher. You put 2 and 2 together, the chart of the NASDAQ futures is reaching 15,000, which is solid resistance. You cannot just pass over 15,000 easily. And you look at this chart and you say, okay, perhaps the VXN will pull a trick here and start to pop higher. And we see the NASDAQ futures pulling back from 15,000. The question is, how high will the VXN go and how low will the NASDAQ go? We'll take that one day at a time. And here's the chart of Apple, a daily chart. Look at that. Almost 10 green candles in a row. It's unbelievable. I don't think I've ever seen this in Apple's chart. 10 green candles in a row. That tells you we have insane flows just by the ETFs. You have all of these fund managers pumping billions and billions of dollars of investors' money to buy the ETFs, in this case Apple, the poster boy for any ETF. And the chart managed to make it all the way, not just above the upper edge of the channel, but also above 172.4, which is now support. The chart went down or retested that and it bounced from it again. All of this is bullish behavior. And again, Apple was a bullish chart when you compare it to the other, even when it was down at 157, The challenge right now is a lot of this flow that scored big in a short amount of time has to face an unwind. And the question is, are they just going to pull all of these flows rapidly and we see the chart collapsing all the way to 157? I doubt it. I think they're going to keep some of those flows in ahead of earnings. We're not going to see the massive pullback until after earnings. But for now, my expectations are this chart will stall. It could pull back. The question is, how big will the pullback be? And here it is, the chart of the day, chart of the week for that matter. Tesla, the souffle hourly chart. Again, it started as a massive gamma squeeze, the typical Tesla whale squeeze, and then the retail crowd started to stampede and buy the chart. And yes, the chart did not respect a lot of the resistance lines because it was under a gamma squeeze. But you look at the behavior at around the trend line in yellow, you can see that the chart did indeed respect the line before moving higher again. Likewise, the chart went down at 995, consolidating for a little while. That tells you that the chart is recognizing these numbers. And then came the pop higher today, the gap higher. It is manipulation to begin with, but what are you going to do? The day started bad for Tesla, a slew of bad news. We heard the story from the LA Times about discrimination against black workers in Tesla, and it's absolutely awful, calling workers monkeys. I mean, any company that does that will not get away with it, but somehow Tesla does. Because your beloved politicians own the stock and they're actively cheerleading for the stock by pumping EVs. But no other company will get away with this. We're talking about the largest racial discrimination suit ever by the state of California. This is a big deal. And then we heard perhaps the most damaging news today in the morning, which is the fact that the Shanghai factory will halt production for a few days. That means 2,000 cars per day being out of production. This will impact Tesla's bottom line in the upcoming earnings dramatically. And then we heard bad news about Reverend Elon and the regulators. And apparently Elon has been getting into yelling matches with the regulators. And then came the news that perhaps Reverend Elon caught the thing. How do you erase all of that negativity? Yep, you announce another stock split. These are master manipulators here. They know how to distract right away. And they found out that announcing a stock split, which is not going to happen, by the way, until the end of the year. But they figured out that this is a good way to distract from all of this and pump the stock higher. Now, my antennas are going all over the place because the last time we saw this intentional and persistent effort to pump the stock higher, it was leading to the insider sales by Elon Musk. So is he planning another batch of dumping and he's just pumping the stock? So after he dumps, he says, the stock is back where it was trading before. Not a lot of damage, because the stock today alone created over $85 billion in value alone. This is the entire market cap of Ford, created in one day alone. For what? A stock split? For a company that the fundamentals are being damaged by a factory shut down in Shanghai? This is absolute lunacy and stupidity. But we go back to the chart and we zoom out to find out the next level to watch out for. And I have 1,090.5. Let's extend that line, and here it is. As you can see, the chart also respected that line today as resistance. So yes, the chart is moving impulsively higher in a rapid manner, and it's getting way overextended in the technicals, but it is respecting these support/resistance lines. Could it be that 1090.5 is the stop for this rally for now, and we see a reversal? Sure, but the reversal will not be confirmed until 995 is lost as support. And here it is, Tulips, BTC, finally above the three amigos. The highest of them was 45,855. The chart's trading well above that now. The problem is, it took a lot of energy to crack above the three amigos, and now the chart's becoming a little overextended in the RSI, meaning perhaps running out of gas too quickly. So whether you want to buy it or not, the most important resistance was defeated today, which is a buy signal, but the chart appears to be running out of gas right away. But this is yet another sign of the retail participation. You see it in AMC, you see it in GameStop, you see it in Bed Bath & Beyond, you see it in Tesla, you see it in Bitcoin. All evidence leads to the fact that retail is participating in a big way in this rebound. And here it is, the chart of AMC. We're looking at a 2 hours chart. We identified the positive formation at around 14.24. Since then, the chart shot up higher to the next resistance at around 21, and it consolidated in a triangle pattern, which was broken today to the upside in a massive gamma squeeze led by a lot of buying of call options, and the chart went all the way to 26. Not only that, but it closed the day above that number, and it's now eyeing 32. The chart is getting way overextended here, but it could produce more juice in this rally all the way to 32. But if it gets to 32, let's say early in the morning, it opens at 32, I would be buying puts with both hands, because that would pause the rally and we will see a massive pullback. Remember, a lot of these call options buyers are buying weekly expiration. They're looking for a quick gain. Once they make that gain, they're in, out, hello, goodbye. So that gives you an opportunity, if you missed out on the ride higher, to catch it on the way down. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the Case-Shiller National House Price Index. This will be important, but it is a lagging indicator. Then we have the Consumer Price Index, the JOLTS, job openings and quits. These will be critically important. We also have Fed Zombies from Philadelphia, Harker, and from Atlanta, Boystick speaking. We'll see what they say, but for now, this is all I got for you for now, folks. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.